What's going on, guys? Welcome back. Welcome back to the channel, guys, where we're going to be jumping into why the dollar rising is going to affect things moving forward. So I'm glad to be here, guys. We're going to go and catch you up here and jump right into it, not waste a moment of your time. So one of the most important things we need to look at today is the bleed out of the S&P. All right. This potential false recovery on precious metals. Obviously, we can always move in the opposite direction, guys. We can always, just because I say something doesn't mean that's where the market is going to go. Obviously, we could get a rebound in gold. We could get a rebound in the S&P. We could see the dollar drop on Monday, and we can fuel cheap money into the S&P to artificially pump it. But as of where we're at right this second, we're going to try to break down for you why the market makers are moving into the direction that we are currently in. All right, so if you guys are just checking out the channel for the first time, we'll wait for you to get down here. I know people are anxious to understand what is going on, which is great. See if we're live here, coming in live. And we'll jump right into it. I mean, we're going to talk about gold. We're going to talk about bonds. We're going to talk about crypto. We're going to go into everything. Yes, Mr. Fool, we are live. So we're going to talk about that dollar rising as well. So hope you're doing well, guys. Welcome back. I know people are coming into the chat. I'll give everybody a minute here. Got a lot to talk about here. We're going to tell you exactly where the markets are moving. They're either moving in or out, but that's pretty obvious, right? People are coming into the chat. Welcome, guys. Welcome. All right, so what I got here, guys, is the S&P 100, not the 500. We're going to look at the majority of the liquidity in the S&P. We're not going to focus on the remainder because as of yesterday, the last Fed meeting just a couple days ago, that 2.7% interest rate and the holding steady of the Fed funds rate at 3.75, we are under the understanding that most of the company, not most of the companies, but some companies on the S&P, that cash is going to be, those dollars is going to be more expensive to service those debts, right? Especially for regional banks, right? We talked about that the last 2 days. So what I have up here now, guys, is the S&P 100. This is derived from a variety of different things. You could argue market capitalization, but really the liquidity, the Apples, the Nvidias, the Microsofts. We're seeing a capital flow out of these today. We are seeing large companies other than AT&T, ExxonMobil, and Chevron, some of these tied to crude, right? Conoco, they're up a little bit. But we are seeing a retreat here. Look, Intel's down a little bit percentage, 3%. We can probably find some more meta platforms down as well. We're starting to see kind of these blue chips per se of the S&P potentially lose a little bit of value here. Apple down a little bit. We're going to tie this back down to where we're going here in the chat. So if you are coming in, welcome back. The dollar has started to creep up. We're going to bring that for you up here on the screen. It started to creep up, and guys, why this is so important is because earlier in the week, the dollar was it was going down, right? We saw that kind of happen. We saw the dollar head for a closing the week in a negative territory, right? And we've seen a little bit of an increase here over the last 24 hours, which kind of ties back into our argument yesterday. If the dollar, see guys, I want you to understand the exact reason of why the dollar rising is problematic for a variety of different things. It's problematic for precious metals because if the dollar rises, right? Think about this for a second. If the dollar rises here on the channel live while you're watching it, what that means is that means that precious metals inversely are correlated to that, right? If the dollar, if the dollar keeps rising, the debt to service those debt on the companies on the S&P becomes harder to service, right? because the dollar is becoming more expensive. All right. And if the dollar continues to rise, it will continue to suppress gold prices. It will continue to make the already tough burden of a lot of these companies on the S&P a lot harder to service the debt because the cost of those dollars is going up. Everything is attached to dollars, guys. All the world debt is attached to dollars. So if we get a scenario where the dollar starts to very rapidly increase, and we can look at other various currencies, fiat currencies around the world today, they are trending down against the dollar because it's rising. And what it means is the debt that is going to have to be serviced has to be paid in dollars. See, so when the dollar starts to rise, these hedge funds that are trading on margin, they start getting calls. They start getting margin calls. You know, their brokers start calling them up. Hey, we got to service this right now, because the cost to borrow becomes harder and harder, right? That's what we got here on the screen here. We got for you the dollar graph. It's very obvious that the dollar is rising, right? And that is a fuel for the debt, right? And why the DXY rising matters is because it makes that debt more expensive to repay. It makes that debt more complicated and hard to service, especially when we take this back a couple days ago after the Fed's meeting, where they're not projecting, not projecting any type of rate cut, really. We're going to end the year kind of where we're at to try to control inflation. So this makes that debt for companies to service a lot more expensive to repay, right? So basically, what this also means, guys, is that it also makes investors kind of weary about going into gold, right? It makes investors weary about going into companies on the S&P because we already have a struggling system. And if we start to get those hedge funds pulling positions out of the S&P, right? Because most of them are leveraged. They're getting margin calls because of the dollar rising. And we saw this yesterday as we saw a large amount of capital flow out of gold to cover this problem of margin, right? We keep tying this back to margin. All these hedge funds, a lot of retail traders as well, they're trading on margin, right? So when the dollar is going to go up, that dollar is worth, that dollar is very expensive. The debt is very, very hard to pay, and their debt is equivalent to the dollars that the brokers need to cover the margin. So that's exactly why today we're going to be diving more into that. So let's go right into the graph. If you guys are just turning in here, we're looking at right here on the graph the dollar index. We were heading, like I said, if you're just tuning in, we were heading for a negative week with the dollar, right? With the Fed report, 2.7% inflation rate, 4.4% unemployment rate. The Fed came openly saying, hey, money is going to be expensive. Dollars are going to be expensive to borrow. They're trying to crush the private lending sector. They're trying to close the door on credit for pretty much companies and retail people, retail investors, and so forth. So with this dollar rising, we're going to get a negative correlation with gold prices, right? We're going to get a negative correlation with the S&P, and that's why we're seeing markets trend down today. And a lot of people will tell you that, oh, gold's recovering a little bit. We're going to jump into that right now. So actually, let's jump into, before we do that, well, let's go to gold. Let's go see gold here. I do want to cover that. All right, so a lot of people are going to look at gold today and they're going to think, it's maybe recovering a little bit. Gold has been on the downswing, all right? And the reason that gold is coming down is because, for one, a lot of hedge funds and institutions were riding the futures market. They were riding gold all the way up. A lot of them were leveraged. And now to de-risk some of that leverage, they are selling gold off to avoid having to avoid their margin calls from the S&P, right? We talked about that yesterday, that gold up here at these higher levels, they're taking profits. Retail was the last capitulation liquidation point right here, right? This is where a lot of retail, this is when CNBC and all the news articles were pushing precious metals to an all-time high, precious metals to an all-time high. Retail started getting in on the way up. And then now, with the very expensive dollar rising, gold is coming down, guys. It is, these things are directly inversely correlated, right? So we have this thing where retail is coming in and hedge funds are coming out, right? And retail is just kind of left up here holding the bag. They're offloading just enough to get out to cover their margin, but they're also getting out because gold is potentially coming down, right? That's what we're looking at. So gold, the S&P, pretty much everything is coming down other than the strength of the dollar. If you guys are just tuning in here, this is different from what was happening just a few days ago, right? We were heading negative. We have the US dollar index. The dollar is appreciating. It's pushing down the price of gold. It's pushing down the S&P because margins are getting called out. The brokers get paid in dollars, guys. So if the dollar rises, you have to think about this. The price for that margin call goes up. The brokers aren't taking gold. You know, they're not taking your stocks at a discount. They are taking dollars, and if you don't, they're going to liquidate you. They're going to close the position out for you, which is going to put even more pressure on an already sensitive system, which is why the Fed Wednesday came public and basically lied to the American people, saying everything is going to be okay. We're trying to bounce this, and you could see Powell's face too. You could tell that it's pretty obvious that, you know, cheap dollars are not going to be artificially pumping the S&P. That was pretty much a big part that was coming to his statement, right? So we have to do a lot of digging into the bond market as well. The dollar is also rising, right? Because the bond yields are attractive. The yield on the bonds, the 10-year Treasury Note, is rising. We saw that into yesterday's afternoon. And we're seeing also foreign investors selling their currency to buy dollars to invest in these high yield US bonds, right? And we're specifically talking about the 10-year Treasury, which we're going to jump into here right now. So we'll look at crude oil in a minute here, and then we'll also kind of tie this back to this cycle theory that we have of potentially this capital inflows into the crypto market, specifically the cryptos that we talk about here on the channel, simply because there's only 21 million. There's only 21 million Zcash. There's only 21 million Bitcoin. There's only 210 million Ethereum Classic. So it kind of ties back to this idea of capital rotation, which we're going to kind of coast into the end of the live stream. Is there anybody here? People are dropping it in the channel here. Appreciate you guys dropping in. So yeah, we're gonna jump right now into what it is that is fueling this rise in the 10-year Treasury Note, right? The 10-year Treasury Note, guys, if you're unaware, it's really the most important financial instrument to kind of gauge the overall health of the market and kind of where the market's going, because a lot of these real assets that, like real estate, are tied to the 10-year Treasury Note. It affects the 30-year mortgage rate. It affects I would say it affects the American people a lot more than a lot of this artificial pumping of the S&P. And then also, we have to see how this is playing into the fact that other foreign investment are going to be exiting out of their currencies into the US dollar because the dollar is strengthening. And then they're going in simultaneously into the higher yields of the 10-year Treasury Note, and while simultaneously pressing down factors like that 30-year mortgage, I'm sorry, rising the 30-year mortgage and pressing down that that demand for that mortgage as well, right? Because we know that the 10-year Treasury Note, if it continues to rise, we're going to see higher interest rates for the 30-year fixed mortgage, and that's going to lower demand and basically cripple a housing market that is already kind of, you know, me being in the real estate business, guys, we've seen a massive dry up of buyers. The buyer pools are very small in the real estate market. There are buyers, but the buyer pools are so much smaller. So if the dollar keeps rising and the 30-year Treasury Note keeps rising, we can obviously make the assumption that those buyer pools will become smaller and smaller. And then when we have an aging population that is aging out of their homes, we can understand that you know, the supply of the housing is going to come in very aggressively over the next 10 years, while potentially pulling down the prices of hard assets, real estate, and things like that. So let's jump in here to the interest rate, or sorry, the yield on the 10-year Treasury Note, because like I said, it is on the way up. We're going to look at the 5-day here. And it's rising. I mean, look, guys, it's taken a very aggressive jump here. We're going to zoom out, show you that. So we're going back up to higher highs on the yield, right? We're not quite there where we were last year. This time last year, we were a little bit higher. We saw kind of this cooling in the housing market. We saw the cooling, and that was tied to this 10-year Treasury Note. Let's look at the 3-year. So let's zoom out. Let's see where we're going here. See what I mean, guys? The 10-year Treasury Note is offering higher yield as a safe haven from a very, very shaky economy, right? We have a very, very shaky economy. We have a very, very shaky S&P 500, NASDAQ, ARCA. We have everything shaky right now. And the reason is, guys, is because the debt keeps climbing. Everything is going to be tied back to this original graph we looked at the beginning of the live stream. These dollars are becoming more expensive. They're becoming more expensive to borrow. Therefore, it is pushing down the price of gold. The dollar is outpacing gold. Okay, it's pushing the price of gold down because the dollar is rising. I want you guys to understand that. The dollar rising is pushing down the price of gold. We are not seeing gold follow the dollar. We are seeing a decoupling from gold because the dollar is rising. If the dollar continues to rise, gold will continue to drop. And the phenomenon here is, we're going to jump right into it, that's not typically the normal, is crude oil rising simultaneously, which I think it was Jolly yesterday in the chat was talking about. You know, crude oil could be going for potentially an all-time high. And I don't know if we were for sure saying $200, but I believe Jolly said that he believes that crude oil is going all the way to $200, and that we're going to see a massive run on crude. We're not going to see the U.S. government save the day on crude oil. I mean, we're already the climb that we've seen in gold, or I'm sorry, the climb that we've seen in crude oil, guys, has been the biggest climb that we've seen in a very, very long time. You know, in the aggressiveness and momentum behind it is not like 2022, even though people on the screen here are looking at the graph And they're saying, well, you know, it kind of looks like it does over here. You know, it kind of jumps up too. This is totally different, guys. This is sparked by uh, warfare going on. That this is spiked by a lot of stuff going on, and this is a very, very fast appreciation of crude. All right, so we have to understand that market makers that saw this coming could go two of one ways. They are thinking that the price of crude is going to continue to go up, or they are going to start unwinding positions and start shorting crude, and that might be kind of why we're getting this let's look at the 5-day chart. See, we're starting to potentially, let's get that for you. So let's go back to February, right? We saw it kind of down, going down trajectory. I could probably run the moving average right here and it would probably show that's where it's going. And then we had the massive spike. So I guess the question is, we were talking about yesterday, is crude going to now become a commodity that people are shorting, right? And that's what we'll have to keep watching, because as aggressively as this thing spiked from $60 a barrel up to over $100 a barrel, theoretically, guys, we could go to all-time highs on crude. So it's very important to note here. Let's jump over here to, we looked at the interest rate here on the 10-year Treasury Note. Like I said, we are potentially on a breakout moment there. Let's look at the S&P 500. This is where it gets interesting, guys, because like I said, the dollar's going up in value only puts more strain on a lot of these companies that are very fragile on the S&P. That obviously too presents a problem. It becomes harder to service that debt, right? So you know, it's kind of a double-edged sword, guys. I mean, the Fed can't really do anything. There's not really much they can do there. So we just have to see how that plays out. We might get, if we come into a scenario where you know, we start seeing a rapid depreciation in the dollar, that would kind of blow all the things that we've said out the window, simply because it would be going against everything macro that we've been talking about here on the channel, including the Fed meeting on Tuesday and Wednesday of this week. It would be the money printer turning back on, essentially. So we would have to see dollars become cheaper to artificially pump this S&P, and we're not likely going to see that because of the Fed meeting and the report that we covered for you, the 17-page report we covered here on the channel. It's not alluding to that at all. So we have to go on what is being talked about, and what is being talked about is the only thing that we can go on. You know, that's the only data we have. So let's jump over here to the crypto markets real quick. Let's see if anything is happening. We're still kind of stuck at this $2.4 trillion market cap, right? We are not seeing too much action. However, are things stabilizing? I think that's kind of the predicament we're in. We're seeing a crypto market, a bond market, 10-year Treasury Note specifically, a precious metals market. We're kind of starting to see potentially a little bit of a stabilization, right? We can go back on every single thing that we looked at here, and we could kind of make the argument. We're coming in on the Friday, so the markets are wrapping up this volatile week, and we could kind of say, are we stabilizing on gold a little bit? Are we starting to find support down here on gold? Have the market makers made enough profits to lock in some stabilization here? We're pulling a rabbit out of a hat, guys. We don't know. We have to see if the dollar keeps rising. If the dollar keeps rising, I believe the S&P and gold will continue a downward trajectory. We'll see an increase in 10-year Treasury Note yield, which will put more further strain on an already fragile real estate market. It will put a strain on other markets, commercial real estate, regional banks, and it will also put a strain on the average American, right? So that's something to keep an eye out on. If the S&P starts continuing to trend down, we are going to see potentially an unwind of large asset managers take their profits over the last year, and we'll see this whole thing continue. It's not going to be an implosion, guys. It's going to be a slow unwinding of assets. And we're also going to take a look here quickly. We didn't do this yesterday, but I was looking at the liquidation maps on the crypto markets. All right, so Bitcoin specifically, there was a lot of liquidations around 72, 71,000 this week. It looks like the liquidations are right here in yellow, just FYI, if you guys are just tuning in. The liquidations on the crypto markets have seemed to slowed. All right, we were looking at liquidations here at 72,000 Bitcoin. We have now kind of those longs have been they're already gone. They're already out of the system, and we might be starting to see a stabilization in the crypto markets, and hopefully in the broader markets as well. We don't want to see really an unwinding of gold. We don't want to see the dollar continue to gain momentum. It's going to push most assets down. That's what it's done this week. At the end of the week, it's been kind of the last moment of kind of recalibration, right? We saw everything drop, including the dollar. We saw value against the dollar drop. And then surprisingly today, we've seen an increase in dollar appreciation against fiat currencies, gold, pushing the price of gold down. We could argue that this is kind of a stabilization in the paper markets as well as the crypto markets. That's why we might see Monday is going to be a very interesting day, guys. It's just FYI. We're going to see how crypto moves over the weekend, and then we're also going to see what happens with the dollar if we can continue to rise. All right, guys, that's all I got right now. We're going to try to catch you up here. I'm trying to give you guys some type of edge here. Hopefully you guys are doing okay with your investments. So we'll try to catch you guys up in the afternoon. I want to cover this heat map in a future video on Bitcoin where some of these liquidations have kind of slowed. And we might just be getting, and guys, we might just be getting a stabilization. I don't want you guys to think we're trying to scare the markets here, because it's not. It's the whole reason the markets are behaving this way today is simply because the dollar is appreciating. All right, that's why foreign investments are selling their fiat to go into dollars, to go into these higher yields on the 10-year Treasury Note and bonds. And then also, gold could be finding support. I don't want people to think that gold is crashing. It's already crashed. It's already crashed from the all-time high. So, we had a little bit of a recovery rally. This could have been a bear trap. Or maybe come down here a little bit on gold, kind of in line with this level that we saw back in October when we saw the initial rally. This was really the initial rally in gold. This kind of brought gold on the map right here back in August of last year. And we also had the crypto markets rally too simultaneously. So we'll just have to, we're in choppy waters is all I'm saying. So it's not that we're not finding support. It's just that the support is hard to find because the dollar continues to rise today, putting more pressure on a volatile week, which we've seen right here, right? At the end of this week, this whole drop is this week. So that's what we're looking at. All right, guys, I'll catch you guys soon. Appreciate you guys tuning in. And if you guys got any comments, leave it in the section. We'll review it later on. Talk to you soon.